Okay. Today we're dealing with future trading. Now, everyone understand. We've been able to explain throughout last week. We did a lot of okay. This is finding 10x project. We completed this. Then we went into checklist. We did checklist, and then we had a little bit of spot trading. Trying to look for the literature for the spot trading. Maybe not here. In another. Then we did a little bit of spot trading. I took you through spot trading in Bybit. If you have not created a Bybit account, please do create a Bybit account. So last week, I showed you how to create a Bybit account. I sent a link in the group. So go to the group, click on that link and create a Bybit account if you don't have a Bybit. Now, if you notice that your Bybit is not opening, please go and download Tubo VPN. I said that before. It's called Tubo VPN. Uh, Once you download, install it on your phone or your device, and then choose a location. I would advise you choose maybe Germany. Yes, Germany would be a good place to choose. Choose that Germany and as location. With this, you have access to IP address from Germany. You become anonymous, and you'll be able to boycott your service provider trying to block you from accessing those crypto websites. So with that, you'll be able to register freely and you're ready for the business of today. Is everybody ready? If everybody is, I am. So quickly, we'll be looking at future. Future trading is buying and selling of financial contracts. Financial contracts. You know, in spot trading, you buy the assets. But in future trading, you're not buying the assets. You're buying a contract. Now, what this contract simply says, you're buying a speculation. You're profiting from speculation. So let's see the definition. It says future trading is the buying and selling of financial contract that obligate the buyer and seller to exchange an asset at a predetermined price and the date in future. The date in future. So on the line, you're buying contract, financial contract. Here, buyers and sellers exchange the assets at a predetermined price and a date in future. Excuse me. Now, so let's break it down. We have two types of contract in crypto trading. We have the future trading and we have the perpetual trading. Our emphasis today is going to be on perpetual trading. What's the difference between the two of them? The difference is that for future trading, the price is fixed and the date is fixed. But for perpetual, the date is not fixed. So here's the difference. You say, what's the difference between the future trading and perpetual trading? A future perpetual contract, known as PEP, is a similar crypto derivative asset, slightly different from a non-future contract. Unlike a regular future contract with an expiration date, here's the difference. Future contract has an expiration date, while perpetual does not. So that being said, quickly, how does it work? The buyer is obligated to purchase the asset. Two, the seller is obligated to deliver the asset. If I purchase the asset, you would deliver the asset. Number three, the price and date are agreed upon in advance. The price and date are agreed upon even before we start the transaction. Right? Okay, great. Why is it done this way? One is speculation reason. Traders basically, like what we do in foreign, we speculate. How do we speculate? I looked at the chart. I said, based on the chart I'm looking, I think Euro USD will go up. And so I got into this. If for any reason this trade start going down, I will be losing money. But because it's going in my direction, I'm in the long, I am making money. That's why I can say I'm making money. Right? That's the same thing here with future trading, perpetual future trading. Right? Please, if you're not following, do let me know. If I'm speaking in Japanese, let me know, please. Then for speculation reason, investor can speculate on future prices movement to earn a profit. So if you speculate that price is going to go up and you enter a long trade, you make profit. But if you say price is going to go up and the price start coming down, you have already speculated. You will start losing money. You will lose money if you continue to go down. And if you continue to go down continuously that way, you might lose all your money. Hedging. Here, participants protect against future price swing by securing a profit price. So you don't want to be on the market forever, or because it's going up, then you not stay on the market forever. You secure a price swing. You secure a price in case the market swings in one direction, swings in opposite direction. Your take profit will close you out in take profit, or you will close you out in stop loss. Now, for managing risk is here, a participant reduces their risk by locking in profits. They are locking in profits in advance or locking in the prices in advance. So I've locked my price. So if I take a trade, let me show you my. Now I take this trade. You can see this trade here. I have a stop loss here. This is my entry. My take profit is above. So I have secured this trade. I have locked the price. If the price goes up, it closes me in profit. If it goes down, it closes me in negative. But I determine the negative is going to close me. Does that make sense? Okay, if that makes sense, let's move on quickly. Great. So, what can be traded in future trading? Now, you can trade commodity like your coffee, like your corn, like your barley. Then you can trade them here. You can trade stock index like S&P, US 30. You can trade that here. You can trade cryptocurrency like Bitcoin, for example, Ethereum. You trade them against USDT or USDC. Now, what's the risk? Future trading can be complex and leveraged. This is where the problem is, leverage. Future trading is a leverage kind of trading, right? I'll explain that. Leverage kind of trading. What leverage means that I could trade with money that is not my money. So it could be complex and leveraged, which can lead to permanent capital loss. At the same time, it could lead to multiple profits. So it's a double-edged sword. Leverage is a double-edged sword. If it works in your favor, it could give you multiple profits, multiple in your profits. But if it works against you, it could take many from you at the same time. Now I'm going to expatiate on this. Order can be executed partially with significant price difference. Of course, there could be a significant price difference between the actual price and the market price, right? Yes, the spot price could be different from the future price, right? Here are a few times to note, and then after this, we'll jump on it right away. Here are a few times to note in future trading. One is long. So when you hear me use the word long, you need to know what it is. Short, leverage, liquidation, and TPSL. So if you see me use TPSL, you know what I'm talking about. Funding, right? So let's go back to it. Long means buy lower with anticipation to make profit when the price rises. However, if the prices decide to go against us, we'll lose money. Remember, it's speculation. You're speculating. In future trading, you're not buying tangible assets. You're betting your price. So more like you're betting your price that this is going to go up. I'll say it will go up. You say it will not go up. So we'll bet money. So if I bet that the market is going to go up, I'm classified as a long trader. But you that say the market is going to go down, you're a short trader. So we already bet money. I bet money, I say it will go up. If price go up, I'll win the bet, I'll take my money and take your money. But if the price goes down, you take the money because you're the short trader. In every market, there are short, there are long. Please note that word for long can be interchanged with buy. And short can be interchanged with sell. Please note that. Leverage. Trading with more money than you have, that's leverage. You're leveraging the broker, you're leveraging the exchange, you're leveraging money that's not your money. It's trading with other people's money. It's called OPM, other people's money. That is borrowing more money than you actually have to trade with the intention of maximizing profits. Let's say you are using 10x as a leverage. This is big sharp, and you have a $50. $50, please. Now, if you take a 10x leverage, your $50 becomes 500. What that means is that it's 50x. Whatever you have, you times it by 10 by the x. But remember, you have 50. So the broker will give you additional 450 plus your 50 to make 500, right? So in actual sense, what you own from this money is only 50. You are 500, but what you own is only 50. That's already bad for you. You understand? The idea why you want 500 is if the trade goes in your direction, you make more profits. Now, let me give you an example. If you are 500, okay, let me give you. If you're trading with 50, let's say we have $50. And you made 5%. What is 5% of 50? Can somebody give me 5%? Your capital becomes what? 500. Let's we're using 10x. We're using 10x. So it's 10x of $50. $50, I beg. I keep forgetting to add the S. So you have 500. $500. Same 5% profit will be $25. Can you see how sweet leverage is? Can you see how leverage can be? How sweet leverage can be? The same 5%, you have made 25. Why? I'm trading with you. I made 2.5, and I'm excited. But you had done 25, and you're super excited. The same way, if it goes against you, I will simply lose 22.5. You would have lost 25. Remember that the fact they gave you 450 to add to your 50 to make 500 doesn't mean it's not your money. It's a borrowed fund, and every borrowed money will be paid. It's just as available for you to take. So what it means, you took a loss of 5%, your balance, no, 5%, your balance will come down to $25. That's what you now have because you have $50. And now what you took is a loss of 5%. You have 25 remaining. Does that make sense? So let's come to liquidation. In crypto, liquidation is your call when your loss exceeds your initial capital. When your losses exceed your initial capital. If you have a loss of 10%, let's assume you have a loss of 10% here. Remember, a loss of, you're using a leverage of 10x and your balance is 500. If you have a loss of 5%, it means that you've lost $25, right? If you have a loss of 10% of your account, you'll be liquidated, right? You get a liquidation notice. Even before you get liquidated, you'd have gotten a liquidation notice. Sometimes you get a liquidation notice at 80%, 85%, 90%, 95% before you get liquidated. Now, the idea is add more money to this. You can either add more funds. If you add more funds to your account, you are safe. But if you don't add more money, it means that you can decide to close your trade by yourself. You can manually close it out, or you set a stop loss. It will close your trade in small loss or in big loss or whatever loss you have set. You are safe. But if you don't do either of these two, you will get liquidated. And that will be that. You have just simply dashed the market some money. Right? And that's where TP and SL is very important. I have seen people go from profit to loss. Let me show you. Okay. See this trade? This was, you see this? This is about 11, right? It could go from this $11 profit to minus $10. Why? Because I probably did not set my stop loss. Take profit, sorry. What is take profit? Take profit is a target at which you're willing to exit the market with your profits. So if you set your take profit, for example, if I come and set a take profits here, this will close me at that point of my take profits. Yes. So if I set this as my take profit target, so if I set this as my take profit target, so this is my take profit target. When this price rise up to this place, it will close because this is price movement. If it gets here, it will close me in profits. But if I don't set take profit, it can get here and come down and go down again. I'll show you a classical example. Because the market is just speculative. Look at it. Did you see price move? It moved up and got to this high, but guess what? It dropped and it went below this level. It's here now. So it means that if I entered this trade here for a long and it got here, I would have made like how many dollars, depending on what I'm trading, maybe like $50 profit, and I didn't take. It will simply go down. When it gets to here, it will become zero. And at this point is minus $50. So I'm in negative of 50 because I refuse to take profits. That's one of the effects of not taking profits. If you don't take profit, the market condition can reverse and you start losing from a trade you already win. Right? Okay, great. Same thing here. I will trade here. I want to take profits. I say, okay, I'm setting this place as my take profit target. If price hits here, I will take profit and I exit the market. But what if price does not get to here and turn and start coming down? I'll start losing. If it hits here, it hits my stop loss. This is my stop loss and this is my take profit. Right? I enter the trade here. My stop loss, my take profit. So I've had this trade, I've had this risk that this is an exit for me and this is an exit. This is an exit for loss and this is an exit for profit. So basically, take profit and stop loss are your exit strategy for both loss and profits. Both are mechanisms to exit trading, either profit or loss, depending on which came first, depending on which. Funding is one part of trading, especially crypto trading, that we don't talk enough. So I'm going to talk about funding. Does not mean, most of you think you already know what it is. Funding is not funding your account. You know, most of you think, oh, it's funding your account. You put money in your account. That's not what it means. It's a term we use in crypto trading. It's used for future trading, especially not just crypto. It's used for future trading, not just crypto. For every derivative trading, you know, forex is derivative trading. So funding is the fee paid by long traders to short traders, or short traders to long traders, depending on the market condition, depending on the market conditions, or depending on the conditions of the market, either way. Now, what's this? You know, when we're trading, spot trading, try to track, sorry, future trading, try to track spot trading. Does anyone know the difference between future and spot at this point? Let me ask that question. What's the difference between future and spot? Let me use something we can relate to. Gold. I can enter a shop and buy gold, an ounce of gold. They will measure it and I'll pay for it, right? Now, before I go to buy that gold, I want to check how much is gold sold today. So I go to the future price. I go and see how much is gold sold today. This is gold. What's the price of gold? So I'm going to find out the price of gold today. Let me go to 15 minutes time frame. This is the price of gold. The price of gold is trading at 2,770 at the moment. That's what gold is trading now. 2,770. Now, this price you see here is a speculative price. This price is constantly trying to track the real price of gold in the shop. So when I use the word spot, I'm referring to the price of gold in the shop. Physical gold I can buy and hold. It's an asset, the asset gold. So the price of the asset called gold is known as the spot price of gold. Why this price we are trading now? Because I bought gold now. There's no gold in my hand. So this is speculative. This is the future price. So when I use the word future and spot, understand that I'm trying to differentiate between spot, that is the physical asset you can hold, and the speculative, this one we're speculating on now. So what is happening is that you can be if you're in the noisy place, you can be. Please help me mute out first.
Mr. Robert, mute your mic.
Wow, that's good.
People will help me to mute out this person talking.
Mr. Mike.
Can this person be muted out, please? Officially, gold has done well over 130 pips this morning. I'm sure that's hit TP2. At least we're sure of TP1. Okay. So let's go. Let's continue. People have got TP2 is 2785. Is that it? 2770. So it's close to TP2. And this is a retracement. Notice that on the long trend, anytime there's a retracement, it offers the opportunity to enter again. So great. Let's continue with our class. So what we're saying is that constantly the future price is tracking the spot price. Future price track the spot price to ensure that they are they are not equal, they are almost the same thing, right? And then the difference between the two prices is called divergence. The difference between the future and the spot is called divergence. However, this divergence can be positive or negative. So note that when price of the future market is higher than the spot price, it's called positive divergence. So anytime the future price, gold is selling for 2,600 and in the market is selling for 2,650, is a positive divergence. At this point, long pays funding to the shorts. Someone will say, but besides, what do we need this information? Because when you start trading future, you notice that you enter trade and your profit doesn't make sense to you. You start wondering if they took money from you. Nobody took money from you. It's just that you are paying. It's either you are paying or you are receiving. So if you're buying, at this point, if you assuming you took and the price of future is higher than the spot price, and you buy, know that you're going to pay funding to the sellers, which is the short. And when is a negative divergence? When the price of future is lower than spot price, then sellers will pay to you. And here, you literally don't see sellers. You just know that after a trade, a small percentage is taken from your money to pay the seller. This money is not paid to the broker, it's not paid to the exchange, it's paid to buyers and sellers in the market, and we refer them to spot, to long and short. Funding fee is a way to make sure future price continuously track the spot price. Is the difference. It's to ensure that differential does not go to the broker, but it goes to the traders too, right? Funding in more exchange is calculated in every 8 hours. That's true. Every 8 hours, that's when exchange is calculated. Exchanges calculate their funding every 8 hours. Most funding in most exchange. This is not correct. In most exchange is calculated in 8 hours. It is paid to the. It is not paid to the exchange, but to the long and short trader. To the long and short traders, depending on the market condition, right? Depending on the market condition, depending which is higher or which is lower. So that being said, quickly, we're going to dive into the platform. How do we trade spots? Trading spots. Sorry, trading features on Bybit. Okay, so are we still ready? So we're going to do more like an intro and continue tomorrow to finish the course. Okay, I'm trying to log into my account. Okay, so here is where we are. So you can see that this is the feature trade. How do you know the feature? You come here. Once you come, if you log into with your phone, you see, you click derivative. Under your stuff, you see derivative. Click on the derivative. Feature trading is called derivative on the smartphone. But here you have spot trading. This is feature trading. So I click on feature trading. It will bring me here. So here, if I click on here, I have cross and isolated. Please, the difference between cross isolated is that if you say cross, you're simply saying that all the money you have on Bybit, they can use it to trade. But when you say isolated, is the only amount you have chosen to trade with. If you lose it, that's all you lose. That's the difference between isolated and cross, right? Okay. So here you can choose the pair you are trading. Then of course, I can use BIT USDT or USDC to trade. So I have BTC USDT, Ethereum USDT, and you could trade. You can cross your pair. You can trade with any other pair, any other cross pairs, right? But here is my advice: if you are trading, please trade the stable coin. Trade a more stable coin, USDT, Ethereum, Atom, the major ones, right? Don't go and get yourself into this coin that will flip up and flip down and wipe away your money. So trade more stable coin, more what's the word I'm trying to get it? Okay, so that's what you see. You have isolated margin and you have cross margin. Okay, all perpetual and future trading supports. This is one way. Here is one way as well. Hedge, you can hedge using USDT. You can hedge using USDT. The perpetual and future contracts with corresponding settlement assets. Here, enable trading of derivative with USD. Value of multi-assets. Isolated margin mode will apply to all perpetual and future contracts. enable apps, blah, 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 blah. Basically, cross will use every font you have. So this is what we currently use. So if you want to change, you click on setting and then you can switch to this. This is your portfolio margin, professional derivative traders, right? So we go back. So here is your chart where you have your chart. So last time I see check, we see trading BTC USD. So we see trade BTC USD, and he has done 5% drawdown. You can see in 24 hours, BTC has dropped 5%. Ethereum has dropped 7%. Solana has dropped 11%. Ripple has dropped 11%, and so on and so forth. But Jupe has increased by 10.4%. Whatever that is, some asset has done about 16%. Is my eye penny? Okay, this has done about 16%. But again, my advice would be to trade more established coin. That's the word. Trade more established coin. You are only trading based on your speculation, right? You're trading based on speculation. Great. So I come here. We'll set limit order. Limit order is if you intend to buy in the future, both for buy or sell. I can come here and select my limit order, right? I can come and select my limit order. Now I can do market execution. If I want to buy at current market price, I'm buying BTC, but I'm paying with T. That's what it means. So I'm buying BTC, I'm paying USD. Not like I'm going to have it. I'm speculating. So what I'm saying is that BTC is going to buy against USD. That's what I'm predicting. So ask me how much do I have to? I'll say this how much I have. I'm spending 25% of whatever amount I have. Here is 10x. So I can come here and say, no, I don't want 10x. I want 5x. I can increase. I want 3x. Remember, the higher the leverage, the more profits. The lower the leverage, the lower profits, right? So if you don't trade 1x, can trade with 3x. I'm not sure. You can do 50x, you can do 100x, right? But of course, they also decide that they will give you big money and they will help you lose big money. Great. So I can confirm. I say, okay, I want 3%. I confirm 3x. Sorry. So you adjust your leverage per trade. Unlike in Forex where you go and set it once and you don't touch it again. Here you adjust per every trade. Right? For every trade, you have reason to adjust it. If I adjust it once, I can continue to trade. Okay. Why this? We wait for my confirmation to go through. Otherwise, okay, great. So you can see my confirmation is x3x. Great. So what price do I want to buy? So I go back to my charts. Let me see my chart. Remember, I told us to create a trading view chart. Who has created a trading view chart? Okay, now it has broken to this point. So I go down to say 15 minutes to view it to find out for movement. Okay, so this is a 15 minutes time frame. So why should I buy this? What did I see? Maybe this engulfing. So I can drag up and check. Have I found a reason to buy? We're going to discuss the strategy here. Have I find a reason to buy, or will he continue to sell? It look as if he's still going to continue to sell to this point. So do I sell or do I buy? So if I sell, that's short. If I buy, that's long. So I can come and say BTC USD, I'm short. So I can come, I've already set up short. Why? Because I see more reason to sell. Price is still pushing down, maybe to this point. So if I put my take profit in, will my stop loss? So my stop loss is going to be above here. In case price come up to test here, I could have my stop loss here. If it gets here, I take stop loss. If we stop loss, and that will be for me, right? Okay, so this is on 15 minutes time frame. If I go to lower time frame of 5 minutes, I'll see more, right? So okay, so here, so whatever, if I said my BTC, what price, I'll put the price where I want to buy. If it's limit order, if it's a market order, I click on market, so I cannot go ahead and execute. So BTC, how much BTC? I'm buying 24% of whatever I have in my account. And I'll come and put my stop loss take profit. So I click on stop loss. So I put my take profit here. I put my stop loss here. And I click on buy, which is long. I click on short, which is sell. And once I do that, I wait for my trade to do what? To run, and it will close. My network is really disturbing. So ladies and gents, that's how to execute your spot trading. If you do have questions, I'd like to take that question or that concern right away. Thank you so much, and talk to me.